Hi, everyone, this is the Encyclopedia channel. The book that this program interprets for you is called Where Does Money Come From? What it wants to answer is how is money created and distributed in modern society, and how is the amount of money determined? And what are its important impacts on the social economy? After watching this video, I believe everyone will have a new understanding of currency. When it comes to where the currency comes from, you may simply think that it is printed by a country's financial and monetary institution or the central bank of each country. However, these banknotes make up only a small fraction of the monetary stock. For example, today, only 3% of the monetary structure of most countries is the cash printed and issued by the central bank, and the remaining 97% is created through other means. In fact, in a modern economy, the bulk of the money supply is created and distributed by commercial banks through credit. This means that every time someone takes out a loan to buy a house, buy a car, or start a business, new money is created. In other words, most of the money we use every day is controlled and distributed by commercial banks, and each of us participates in the creation of money. In addition, what you may not have imagined is that in the banking business, it is not necessary to use deposits to issue loans, but to use loans to create deposits, limited. What really matters is the confidence of the banks. In other words, banks are not an intermediary for people to borrow money, but a source of money creation for the economy, and the role of central banks in money creation is much more passive than many people imagine. The conclusions of this book are astonishing, but the arguments are very serious. It was written by 4 British finance scholars by consulting more than 500 documents and business guidelines of central banks, regulators, and other financial institutions, and has also been recognized by authoritative scholars. For example, Charles Goodhart, a member of the British Academy of Sciences, that is, the proposer of Goodhart's Law, made a preface recommendation for it. As some scholars have said, the frontier of financial knowledge is not in the classrooms of research institutions and universities, but in the counters and business negotiation tables where customers are in contact. When this knowledge is written into papers and then compiled into textbooks, has fallen behind reality and is no longer alive. From this point of view, the knowledge described in this book is more real, more accurate, and more cutting-edge than the knowledge we see in textbooks. Of course, the creation and distribution of money is not only a matter of knowledge, but also a matter of interest. Because the credit currency created by banks does not flow evenly. Because of incentives, banks are more inclined to lend to clients with collateral or assets than to lend to productive investments. Therefore, incremental funds are more likely to flow to real estate and financial speculation than to small businesses and manufacturing, thereby affecting the interests of different social groups. Therefore, the content of this book deserves everyone's attention. Now, we will interpret this book in 3 parts. The first part is how money is created and what role banks play in money creation. The second part is how to determine the amount of money created by banks and what role the central bank can play in it. The third part is the flow of money created by banks what are its important impacts on the social economy. It is hoped that the discussion of these issues can unravel the mystery of currency creation and see clearly one's own position and interests in the modern financial system. First part. First of all, let's look at how money is created. In other words, where does the money we use every day come from? Regarding this question, ordinary people may think that the currency is printed by the state, or, people with a little knowledge of economics may think that the currency is issued by the central bank, and the currency issued by the central bank goes through the so-called fractional reserve system, plus the deposit and loan cycle of commercial banks forms the currency in circulation. For example, there is a bank in a small town, and the reserve ratio stipulated by the central bank is 10%. A worker deposited his 1,000 yuan into this bank. The bank kept 10% as a legal reserve, that is, 100 yuan, and then used the remaining 900 yuan to give a farmer a loan. The farmer used the 900 yuan to buy furniture store B's table and chairs, and B deposited the 900 yuan in the bank. The bank retains 10% again, which is 90 yuan, and then uses the remaining 810 yuan to lend to a restaurant owner C, and so on. This process continues indefinitely, each time generating new loans and deposits, which can eventually add up to 10,000 yuan in currency. This is the money multiplier model that textbooks tell you. According to this model, most people believe that banks are only financial intermediaries for currency circulation and cannot determine the money supply in the economy. The central bank is the one that really controls the amount of money, because it can issue new base currency and set reserve ratios, while the growth of money supply is limited by the deposit reserve ratio and the base currency. But this book tells us that this is not the case. In reality, the reserve requirement ratio in many countries is extremely low, or even zero, and there is almost no constraint on commercial bank lending, and in the banking business, it is not necessary to use deposits to issue loans, but to use loans to create deposit. Therefore, in modern society, most of the currency in circulation is created by commercial banks. To illustrate this, let's look at a case. Alan wants to renovate his house, but he doesn't have enough money. So he went to ICBC and wanted to borrow $100,000. The bank looked at his pay stubs and credit history and decided he was a reliable customer who would pay his bills on time. So the bank signed a contract with Alan, which stated that Alan would return $100,000 plus interest to the bank within 3 years. This contract is a valuable asset for the bank, because it represents the money Alan owes the bank, and the bank will credit this money to its own assets. At the same time, the bank opened a new account for Alan and added $100,000 to it. The $100,000 is a deposit for Alan and a liability for the bank, because Alan can withdraw $100,000 through it at any time, so the bank also records this money as its own liability. In this way, banks expanded their balance sheets. But in fact, it just entered some numbers into the computer, indicating the loan relationship between it and Alan. The loan allows Alan to spend up to $100,000 from the account using his card, check, or wire transfer. This is the process by which loans create deposits, or in other words, credit. The numbers that the bank puts into Alan's account can be used as money, so it's like currency. Now let's assume that Alan uses this money to pay rent to his landlord, Kevin. What will happen to the bank account? If Alan and Kevin are at the same bank, the transfer is simple. As long as Alan tells the bank will change the number on the computer, so that Alan's account will be reduced by $5,000, and Kevin's account will be increased by $5,000. This way, you don't have to use any cash, and you don't need to ask the central bank for help. But if Alan and Kevin are in different banks, for example, Alan is in Bank A and Kevin is in Bank B, then the transfer will be a little more troublesome. One way is that Alan withdraws $5,000 in cash first, and then hands it over to Kevin, who then deposits it into his account. Of course, this is very inconvenient. Banks have two better options. One way is for banks to use their accounts at other banks to make direct transfers and just figure out who owes whom in the end. This is the so-called bilateral liquidation. Another way is for banks to use their accounts with the central bank. You know, just like we have an account in a certain bank, each bank also has an account in the central bank, called a reserve account. Also, just like we have to maintain a sufficient balance to make payments, each bank has to maintain a certain reserve balance to make payments to other banks. When a bank has insufficient reserves, it can sell securities to the central bank to increase its reserves, or it can borrow directly from the central bank to increase its reserves, and the central bank's balance sheet expands. So, if Alan pays Kevin $5,000 across the bank, what happens in the account? We can explain it in 5 steps. In the first step, Alan tells Bank A to transfer $5,000 to Kevin. In the second step, Bank A changes the number on the computer, which reduces Alan's account by $5,000. In the third step, Bank A tells the central bank to transfer $5,000 is transferred from its reserve account to Bank B's reserve account. In the fourth step, the central bank changes the number on the computer, so that Bank A's reserve account is reduced by $5,000, and Bank B's reserve account is increased by $5,000. In the fifth step, Bank B tells Kevin that his account has an extra $5,000. This completes the transaction. What happens in the end? The central bank's reserve balance remains unchanged. Bank A's reserves are deducted by $5,000, and Bank B's reserves are increased by $5,000. Bank A's deposit liability to Alan is reduced by $5,000, and its reserve assets to the central bank are also reduced $5,000. Bank B's deposit liabilities to Kevin increased by $5,000. and its reserve assets to the central bank also increased by $5,000. In this way, on the balance sheets of the central bank and individual banks, the accounts are equal and balanced. Speaking of this, we know that in contemporary society, except for a small amount of banknotes, most currencies are just digital records in computers. Whether it's our deposits or the central bank's reserves, it's just some form of computer data. And in the banking business, it is not necessary to use deposits to issue loans, but to use loans to create deposits. Commercial banks are the main source of money creation. But in this case, you may ask, can banks create money without limit? The second part. This is related to what we are going to say next. What factors will banks consider when creating money, and what role can the central bank play in it? We can look at it from three angles: interest rate, reserve ratio, and capital adequacy ratio. First, look at interest rates. It is often believed that the amount of money created by banks is controlled by central banks by adjusting interest rates. The higher the interest rate, the greater the income of the bank from lending, but the burden on the borrower will also increase. If the interest rate is lowered, the income of the bank will decrease, but the pressure on the borrower will be less. The central bank can adjust the interest rate according to the economic environment to influence the scale of credit and money supply. However, this book tells us that the main factor that determines how much a bank lends is not the interest rate, but the bank's confidence in the repayment ability of the borrower and the stability of the financial system. Banks place more emphasis on avoiding loan defaults than on securing high interest rates. Because in the event of a loan default, the bank may lose all of the principal. If banks are confident about future economic conditions, they will lend more and create more money. Conversely, if they are not confident about future economic conditions, they will lend less and create less money. Therefore, the scale of credit and the money supply of a country depend more on the bank's view of the future. Then we look at the reserve ratio. This is the proportion of cash or other liquid assets that commercial banks deposit with the central bank for emergency or transfer purposes. Generally speaking, we believe that the higher the reserve ratio, the less money banks can lend or invest. The lower the reserve ratio, the more money banks can lend or invest. The central bank can control banks' creation of credit and money by adjusting the reserve requirement ratio. But in practice, the ability of banks to create new money has little to do with the amount of reserves they have at the central bank. As mentioned earlier, in many countries, the requirements for the reserve ratio are extremely low. For example, during the financial crisis, British banks only needed to deposit £1.25 in reserves for every £100 of credit they issued. Because the electronic clearing system that the bank participates in will offset the payment multilaterally at the end of each day's business, the bank actually only needs to hold a small amount of reserves to meet the payment requirements. The author even believes that it is not the central bank that controls the credit scale of commercial banks, but the commercial banks that determine the amount of the central bank's reserves, because the central bank needs to meet their reserves to ensure the normal operation of the financial system. Finally, we focus on the capital adequacy ratio. The so-called capital adequacy ratio is actually the ratio of the bank's own capital, such as equity, surplus, etc., to their risk assets, such as loans, etc. This ratio reflects the ability of the bank to bear the loss of risk assets with its own money. According to international practice, the bank's capital adequacy ratio should be above 8%. That is to say, for every loan of 92 yuan, 8 yuan needs to be backed up. Therefore, many people believe that the capital adequacy ratio can limit the bank's lending and asset scale. But the author of this book believes that the capital adequacy ratio does not limit the creation of credit. Because retained profits count as capital, the more profitable a bank is, the more profits it retains so it can make more loans while still meeting capital adequacy requirements. For example, a bank made a profit of 10 million yuan last year, of which 5 million yuan is regarded as retained profit as capital. So, it now has an additional capital of 5 million yuan, which can be used to support more risky assets. According to the 8% capital adequacy ratio requirement, the 5 million yuan can support a new loan of 62.5 million yuan. If the bank maintains good profitability, then it can continue to expand the size of loans, while meeting capital adequacy requirements. Of course, if a bank's profitability declines, then the amount of capital that can be reserved will decrease, and the corresponding loan size will be limited. But it's not that capital adequacy ratio requirements directly limit loan issuance, but that a bank's operating conditions affect its lending capacity. So, while the capital adequacy requirement has an impact on banks' risk tolerance and loan size, it does not directly limit credit creation. What really affects credit creation is actually the profitability of banks. Also, higher capital adequacy ratios don't necessarily prevent banks from increasing credit when times are good. This is because, first, economic prosperity is usually accompanied by asset or collateral appreciation, which allows banks to lower their estimates of loan risk, thereby reducing the need for capital, allowing banks to maintain the same capital adequacy ratio. In such cases, more loans are issued. Second, an optimistic estimate of the economic outlook will also encourage banks to make more loans, generating more profits, which increases capital and allows banks to make more loans. Third, it would be easier for banks to raise more capital if regulators adopted raising capital adequacy ratios as a countercyclical macroprudential policy. For example, funds for purchasing newly issued preferred shares are ultimately created by the banking system, and more money is created during boom times. So, we must not forget a key fact: banks are the creators of the money supply. Requiring banks to raise more capital during a boom does not stop the boom. Because this boom is caused by increased bank credit, banks can use part of the money supply expansion to finance higher capital ratios. So the capital adequacy ratio does not limit the creation of money, nor does it limit the expansion of bank balance sheets. In short, the money supply in a modern economy is actually created by credit, and policies such as interest rates, deposit reserve ratios, and capital adequacy ratios have limited impact on credit creation. A country's money supply, largely determined by banks' expectations about the future, is the result of individual bank lending and asset purchase decisions. The third part. So, when banks create credit and expand the money supply, where does the money created go? What impact does it have on the social economy? Speaking of this issue, we must first be clear that when banks create credit, whether the currency is used for GDP transactions or non-GDP transactions has a very different impact on the economy. The so-called GDP transactions refer to transactions related to production and consumption, such as purchasing goods and services, investing in fixed assets, and so on. Non-GDP transactions refer to transactions related to the transfer of existing assets, such as the purchase of real estate, stocks, bonds, etc. When banks create credit, it boosts economic growth and employment if that money is traded in GDP. Because these loans are used to produce new goods, new services, or increase productivity, they can increase aggregate demand and aggregate supply in society, leading to non-inflationary growth. This credit creation is productive. It can improve social welfare and economic efficiency. But if these currencies are used for non-GDP transactions, then asset prices will inflate, bubbles will burst, and resources will be misallocated. Because these loans are used to buy assets that already exist, they do not increase aggregate demand and supply, but only push up asset prices. When asset prices rise, people feel richer, which increases consumer spending, leading to inflation. At the same time, banks will also loosen lending standards due to collateral appreciation, further exacerbating credit expansion and asset bubbles. When the bubble bursts, asset prices plummet and banks tighten lending standards as collateral values fall, further exacerbating the credit crunch and financial crisis. This credit creation is unproductive, and it damages social welfare and economic efficiency. So, in practice, which type of transactions do banks tend to lend to? The answer is non-GDP transactions. Because the incentive mechanism determines that banks are more willing to lend to customers with collateral or assets than to lend to productive investment. Because the former has lower risks, higher returns, looser regulation, and less competition. Thus, during credit expansions, incremental funding tends to be more likely to flow to real estate and financial speculation than to small businesses and manufacturing. This has had a profound impact on the socioeconomic. We can illustrate this with two cases. The root cause of the 2008 global financial crisis was the credit bubble in the U.S. real estate market. In an environment of deregulation and low interest rates, U.S. banks issued a large number of subprime loans to home buyers with bad credit, which were packaged into financial derivatives and circulated globally. When house prices rose, those loans looked safe, and banks and investors alike made big bucks. But when house prices fell, those loans became unrepayable, and both banks and investors struggled, leading to a financial crisis and recession. The outbreak of the new crown epidemic in 2020 has also had a huge impact on the global economy. In response to the demand contraction and supply disruptions brought on by the pandemic, governments and central banks have unleashed unprecedented fiscal and monetary stimulus, substantially increasing public spending and credit creation. These measures have alleviated the pressure of economic downturn to a certain extent, but also brought the risk of inflation. In the process of bailing out the crisis, some countries adopted quantitative easing policies. When the interest rate has dropped to zero or close to zero, the central bank buys long-term bonds such as treasury bonds to increase the base money supply to encourage spending and borrowing. It helps to improve market confidence and alleviate the impact of the financial crisis and economic recession to a certain extent, but there may also be problems mentioned above. Because central banks buy bonds, they don't directly create new credit for households, businesses, or governments. Rather, the financial investment sector may create new credit, and they may invest this purchasing power in corporate bonds or stocks, or in derivative transactions on commodities such as oil, driving up the prices of these assets. At the same time, companies that are able to issue debt or equity to raise capital may choose to use the funds to pay down existing bank debt rather than invest in productive activities. This would have the paradoxical effect of reducing credit creation and reducing the money supply by exactly the same amount that QE increased. The banking industry, after receiving new reserves from the central bank, can choose to expand lending to the real economy, or it can simply sit on reserves. The central bank pays banks 0.5% interest on reserves, the most liquid asset a bank can hold. If banks do use this extra liquidity to create credit, they may also use it for transactions that increase profitability but do not contribute to GDP, such as mortgage lending, foreign exchange trading, or commodity speculation. In short, the increase in money supply does not necessarily promote economic growth, but depends on where the money is used. If we want to achieve sustainable development, we need to change the incentive mechanism of bank credit and guide more funds to productive investment rather than unproductive speculation, so that the newly born currency can benefit society. Now, let's summarize. This Where Does Money Come From is a handbook of money and banking knowledge written in popular language by 4 British finance scholars based on first-line materials and expert interviews. While deeply analyzing the theory of money and banking and the history of financial development, it puts forward some new theories that subvert traditional concepts. The main idea is that most of the money supply in the modern economy is created by commercial banks through the issuance of credit. In addition, it also highlights a few points. First, in the real world, where information is not fully transparent, credit is allocated by banks. The main factor that determines bank loans is not the interest rate, but the bank's confidence in the repayment of the loan by the borrower, as well as confidence in the liquidity and solvency of other banks and the entire financial system. Second, while the capital adequacy requirement works in some ways, it does not and cannot limit the creation of money, nor does it necessarily limit the expansion of bank balance sheets. In other words, capital adequacy requirements are largely ineffective at preventing excessive credit expansion and asset price bubbles. Third, banks determine where credit goes in the economy. For incentive reasons, banks prefer to lend to clients with collateral or assets rather than lending to productive investments. As a result, new capital is more likely to flow to real estate and financial speculation than to small businesses and manufacturing, with profound socioeconomic implications. These viewpoints have important reference value for us to understand the operation of the monetary system, improve monetary policy regulation, and enhance the effectiveness of financial supervision. Finally, it is particularly worth adding that the fact that the government is not directly involved in the process of creating and distributing money does not mean that the government has no influence over money. On the contrary, it is precisely because of government endorsement that currency can become a common unit of account and means of payment. Only responsible and trustworthy governments can shape a stable currency. This is the end of this episode of the show. What do you think about it differently? Welcome to leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.